You're listening to Know What You Are Investing, the podcast that takes you inside the numbers and behind the strategies of the world's most influential companies. In today's episode, we break down Microsoft's Q4 2025 earnings, a quarter defined by record-breaking revenue, relentless demand for AI infrastructure, and a bold vision for what's next in cloud, data, and software. From Copilot momentum and quantum computing to data center expansion and global growth, we're diving deep into the forces shaping Microsoft's future. Let's get started.
Welcome to the Deep Dive. This is where we decode the world's top companies, exploring what they do, how they grow, and why it truly matters for you. Today, we're embarking on a deep dive into the latest from Microsoft. They just came off their Q4 2025 earnings briefing, and, the results are pretty staggering. We're talking about a quarter that didn't just meet expectations, it really shattered them, propelled by surging AI demand, massive Azure growth, and what feels like a full-blown Copilot revolution starting to take hold. So our mission today is to unpack the intricate insights behind these record-breaking numbers. We want to understand how Microsoft is deftly navigating everything from data center constraints to complex market dynamics, and ultimately why they seem so confident about another year of strong growth in fiscal year 2026. What's truly important here, and what does it mean for the future of tech and investment, not just for Microsoft, obviously, but really for the entire digital economy?
Indeed. And this isn't just, reviewing a quarterly report. We'll be looking far beyond the headlines. We really want to explore the profound strategic implications of Microsoft's recent decisions and how they're meticulously positioning themselves for enduring AI dominance. It's a truly fascinating moment in the tech landscape, isn't it?
It really is.
We're witnessing, and I think participating in, a generational shift in how technology fundamentally transforms work and, just daily life.
All right, let's unpack this then. Let's start with some top-line figures that truly tell a story. Microsoft just wrapped up fiscal year 2025 and what they delivered in Q4. Well, it can only be described as a phenomenal quarter. It prompted a palpable wave of positive sentiment across the analyst community, too.
Yeah, what truly stands out here is how consistently the company exceeded expectations right across the board. So for Q4 2025, Microsoft reported earnings per share, EPS, of $3.65.
Okay.
Now, this wasn't merely a beat. It surpassed analyst estimates by a robust $0.27.
Wow, 27 cents is quite a beat at their scale.
It really is. To put that in perspective, for a company of Microsoft's size, hitting that kind of beat signals not just strong execution, but a remarkable underlying financial performance. It clearly impressed even seasoned market watchers. And then on the revenue front, they hit $76.44 billion.
$76.4 billion.
Yeah, which represents an astonishing 18.40% year-over-year increase. That's exceptionally strong for a company this mature, this large.
Absolutely.
And again, this figure didn't just meet expectations. It decisively surpassed analyst projections by a solid $2.60 billion.
$2.6 billion above expectations. That's significant.
It is. This kind of broad-based strength, consistently outpacing market forecasts, it serves as a clear and unambiguous signal, powerful momentum across their diverse portfolio.
So if we look beyond just the impressive headline numbers, what's the real insight here? What's the takeaway?
Well, it signals broad and pervasive strength across their entire product and service portfolio.
Right.
And it's undoubtedly driven by tenacious execution from their global sales and partner teams.
It seems like every strategic decision, every product launch, every customer engagement just sort of came together harmoniously this quarter, exceeding even the most optimistic forecasts, it feels like.
Exactly. This isn't just a win. It's a profound testament to their strategic foresight and masterful execution. And this is happening in what continues to be a rapidly evolving, highly competitive market.
Okay, so that's Q4. Let's drill down into the full fiscal year results. This should give us a more comprehensive picture of the overall financial health and the strategic direction of the company. These full year numbers, frankly, tell an even more compelling story, don't they?
They absolutely do. So for the full fiscal year 2025, Microsoft delivered over $281 billion in total revenue.
$281 billion.
Yep. That marks a substantial 15% increase year over year, which, again, for a company of this magnitude, demonstrates an incredible ability to scale while maintaining impressive growth rates. This figure truly reflects that pervasive strength we talked about, across their entire product and service portfolio.
Right.
It makes it clear that their growth isn't isolated to just one segment, It's a robust company-wide phenomenon.
And profitability keeping pace.
Very much so. Their operating income also saw incredibly robust growth. It reached over $128 billion, which is up 17% year over year.
Wow.
And this is a critical indicator, right? It tells us that their strategic investments, particularly those massive commitments in high-growth areas like AI and cloud infrastructure, they're not only paying off, but they're doing so with remarkable efficiency. They're managing their cost structures while driving substantial top-line expansion.
That's impressive discipline.
It is. And here's a truly significant milestone this fiscal year. The Microsoft Cloud surpassed an eye-watering $168 billion in annual revenue.
Whoa. $168 billion just from the cloud businesses.
Just from cloud, growing by an impressive 23%. This isn't just a number to glance over. It fundamentally solidifies their, frankly, unparalleled leadership position in cloud services. This scale isn't merely about market share. It's a competitive moat. It's built on deep, multi-year customer commitments and an unparalleled level of enterprise trust.
Which is crucial right now.
Absolutely crucial. In an era where data sovereignty, security, and the reliable orchestration of AI workloads are paramount, this level of scale is a formidable competitive advantage. Others, like Amazon and Google, they're still scrambling to replicate it. It underscores the massive, ongoing global shift towards cloud adoption, and Microsoft is clearly at the forefront.
And Azure is the core of that, right? How did it perform individually?
Right. Azure is the cornerstone of that monumental cloud business. It reached over $75 billion in annual revenue itself, surging by 34%.
34% growth for Azure. Still accelerating.
Still accelerating. And what's perhaps even more impressive, maybe more indicative of its strategic strength, is that Azure consistently gained market share. Every single quarter this fiscal year.
Every quarter.
Yeah.
Against AWS and Google Cloud.
Every single quarter, this relentless quarter after quarter share gain in such a fiercely competitive market populated by tech giants, it speaks volumes. It speaks to their product superiority, their robust sales engine, and their unparalleled ability to attract, onboard, and retain the largest, most demanding enterprise customers for their most critical, complex workloads.
Okay, now, here's where it gets really insightful for investors, especially those looking at future revenue visibility and the underlying health of Microsoft's sales engine. Commercial bookings. They exceeded $100 billion for the first time ever, increasing a massive 37% year over year.
That's right, an absolutely unprecedented surge.
What precisely fueled that, and why does that number tell us so much about their trajectory?
Well, this extraordinary bookings figure was fundamentally fueled by a trifecta of strengths.
First, robust execution in core annuity sales. That's essentially those recurring revenue streams that provide incredible stability.
Right, the predictable stuff.
Exactly. Second, consistently healthy renewals of existing contracts. That indicates high customer satisfaction and a very sticky product ecosystem.
They're keeping their customers happy.
They are. And critically, third, a significant increase in the number of large contracts. We're talking about both $10 million and $100 million plus deals across both Azure and Microsoft 365.
So not just small additions, but big commitments.
Huge commitments. This isn't just incremental growth. It indicates that major enterprises worldwide are making deep, long-term, multi-year commitments to Microsoft's ecosystem. At a scale we simply haven't witnessed before, it shows a profound level of confidence in Microsoft as a strategic partner for their most ambitious digital transformations, particularly, those involving AI.
And that flows into their backlog, the RPO, precisely. Reflecting this momentum, their commercial remaining performance obligation, or RPO, which is essentially their contracted backlog of future revenue, yet to be recognized, it increased to an astounding $368 billion.
$368 billion.
Also up a massive 37%. This substantial and growing backlog provides unparalleled visibility into future revenue streams. Think of it as a massive pipeline of guaranteed future business.
That's incredible visibility.
It is. Roughly 35% of this RPO is expected to be recognized in the next 12 months. That portion itself is up a substantial 21% year over year, and the remaining 49% comes in beyond that. Crucially, the annuity mix, which represents their highly predictable recurring revenue, remained exceptionally high at 98%.
98% recurring. Wow.
Yeah, further reinforcing the incredible predictability and resilience of their revenue streams. This RPO isn't just a number, it's a strategic asset. It provides a bedrock of stability for future growth.
It's phenomenal to see such robust growth. But for a company of Microsoft's profile, the inevitable question becomes, How are they balancing this aggressive expansion with disciplined financial management? How are they ensuring continued profitability, especially given the massive investments required for AI?
That's an excellent point, and the numbers here are quite telling. The company's overall gross margin percentage was 69%.
Okay, 69%.
Which is only down a modest 1 point year over year.
Only 1 point despite all that AI spending.
Right. This slight dip was primarily a strategic trade-off, really, driven by two key factors. One, a sales mix shift towards Azure, which typically has lower initial margins as new capacity comes online. And two, the substantial necessary impact of scaling their monumental AI infrastructure. However, it's crucial to note that this was partially offset by continued impressive efficiency gains within both Azure and M365 Commercial Cloud. This demonstrates their remarkable ability to optimize operations and extract more value from existing assets, even during periods of unprecedented capital intensity.
So they're getting better at running what they have, even as they build more.
Exactly. Now, specifically, the Microsoft Cloud gross margin percentage came in at 68%, so that was down 2 points.
Okay, cloud margin's down 2 points.
Right. And again, this is a direct reflection of those significant strategic investments in building out the world's leading AI infrastructure. It's a calculated decision. Microsoft is prioritizing long-term market dominance and capturing the immense AI opportunity, even if it means a slight temporary impact on current gross margins. They are betting on the future, and their strong cash flow allows them to make that bet.
Makes sense. What about operating expenses and overall operating margins?
Well, what's even more impressive on the profitability front is that operating expenses increased only a modest 6%.
Just 6%.
Just 6%, while operating margins actually increased a healthy 2 points year over year, reaching 45%.
Operating margins up 2 points. How did they manage that with only 6% PX growth?
It wasn't accidental. It was driven by that better-than-expected revenue growth we talked about, coupled with an unwavering focus on operational efficiency across the board. And here's a truly remarkable detail. Their headcount, notably, remained relatively unchanged year over year.
Flat headcount with all this growth.
Essentially flat. This highlights their ability to scale operations and absorb massive new workloads without significantly expanding their human workforce, largely thanks to productivity gains driven by automation and increasingly, their own AI tools like Copilot.
Eating their own dog food, so to speak.
You could say that, yeah. Now, let's talk about capital expenditures, CapEx. This truly underscores the scale of their ambition. CapEx stood at $24.2 billion for the quarter.
$24 billion in 1 quarter.
With $17.1 billion in cash actually paid for property, plant, and equipment. This is a monumental investment and is highly strategic. Over half of this spend went into long-lived assets, think massive data center buildings, long-haul fiber assets designed to support monetization for 15 years and beyond. The remainder was allocated to servers, CPUs, and critically, GPUs, all directly driven by the surging, undeniable demand signals for their cloud and AI services.
So it's not speculative spending?
Absolutely not. It's a direct, necessary response to that colossal $368 billion contracted backlog we just discussed. They are building to fulfill existing demand. They need this capacity.
Okay. And how does this impact cash flow? Are they burning through cash?
Not at all, actually. Their cash flow from operations was incredibly robust at $42.6 billion, up a strong 15%, primarily driven by accelerating cloud billings and efficient collections.
$42 billion in operating cash flow.
Which translates into immense financial flexibility. Free cash flow, so that's after CapEx, came in at an impressive $25.6 billion.
But still generating over $25 billion in free cash after spending $24 billion on CapEx.
Exactly. It indicates exceptional liquidity and the ability to self-fund their aggressive growth and investment plans.
And finally, for shareholders, the good news continued.
It did. Microsoft returned a substantial $9.4 billion through dividends and share repurchases in Q4.
Almost $10 billion back to shareholders.
Bringing the full fiscal year total to over $37 billion returned. This clearly demonstrates a strong ongoing commitment to returning capital, even while making truly historic investments in their future growth engines like AI. It's a delicate balancing act, and, well, they appear to be managing it exceptionally well.
Okay, it's abundantly clear that a huge, if not the defining part of Microsoft's success story right now is AI. Let's truly dig into how Microsoft is not just leveraging AI, but literally building the foundational infrastructure for the entire AI era from the ground up to meet this unprecedented, almost insatiable demand.
Yeah, Satya Nadella put it very succinctly. He said Microsoft is building the most comprehensive suite of AI products and tech stack at massive scale.
Comprehensive is the key word there, isn't it?
It really is. What comprehensive truly means here is that they're addressing every single layer of the AI stack, from the foundational silicon and server infrastructure all the way up through the systems, the core models, and then integrating AI seamlessly into widely adopted applications. This isn't just about using AI, it's about being the foundational, indispensable platform upon which the entire AI ecosystem operates. This proactive, full-stack stance positions them as an absolutely critical player in the ongoing AI revolution.
And Azure is the engine for that infrastructure.
Azure, already a powerhouse in cloud computing, is undeniably at the forefront of this AI infrastructure wave, consistently gaining market share against formidable competitors, as we noted. This consistent accelerating growth in Azure is significantly driven by their largest, most demanding customers, the Fortune 500, global enterprises who are increasingly relying on Microsoft for their most critical AI workloads. These are not small-scale projects. These are core business transformations.
Why are they choosing Azure over others for these big AI projects?
Well, it's not just about raw compute power, although they offer that. It's also about enterprise-grade security, its existing deep integrations with their IT infrastructure, and its hybrid cloud capabilities, which are still paramount for many large organizations, and, frankly, the trust factor.
Right, and they're building data centers like crazy to support this.
At an astonishing rate. They've opened new data centers across 6 continents. They now boast over 400 data centers spanning 70 regions worldwide.
400 data center.
A network far more extensive than any other cloud provider. To give you a concrete sense of this scale, they've added an incredible 8 gigawatts of new capacity in the last 12 months alone.
8 gigawatts. That's huge.
It is. Scaling their infrastructure faster than any of their closest competitors. This relentless global expansion is absolutely key to meeting the insatiable demand for AI compute, ensuring low latency, and addressing critical data residency requirements across diverse geographies.
What's particularly fascinating here is Microsoft's explicit focus on making every Azure region AI first. What precisely does that mean? For performance, and crucially, for the flexibility required to handle these incredibly intensive and evolving AI workloads.
Yeah, AI first means these regions are purpose-built for the demands of modern AI. For example, all their new regions, and many existing ones, can now support liquid cooling.
Liquid cooling. Okay, why is that important?
Well, it's vital for the high-density server racks and powerful GPUs required by advanced AI models. It allows them to pack more compute power into a smaller footprint and manage the intense heat more effectively. This also dramatically increases the fungibility and flexibility of their entire fleet. It makes it easier to reconfigure and optimize resources on the fly for different types of AI workloads, whether it's large model training or high-volume inference.
So they can shift resources around more easily.
Exactly. They're effectively riding what Satya Nadella describes as compounding S-curves across silicon systems and the AI models themselves.
Compounding S-curves. Explain a bit.
Think of it like this. Each layer of innovation isn't just adding to the stack, it's multiplying the gains of the layer below it. So breakthroughs in custom silicon immediately boost system performance, which in turn optimizes how the AI models learn and operate. It creates this powerful, virtuous cycle of accelerating efficiency and capability, and their competitors are finding it incredibly difficult to match that at this scale.
Can you give a concrete example of that optimization?
Absolutely. A prime, tangible example is with the GPT-4o family of models. Through software optimizations alone, without even touching the underlying hardware, Microsoft is now delivering 90% more inference tokens for the same GPU compared to just a year ago.
90% more performance from the same chip, just through software.
Just through software. This highlights a critical point. Software efficiency plays a massive, often underestimated role alongside raw hardware build-out. It drives AI performance and, crucially, cost-effectiveness. It's not merely about building more data centers, it's about building them smarter and making every component of the stack work harder and more efficiently.
Beyond just general AI infrastructure, they're clearly innovating in highly specialized areas too, recognizing that diverse customers have truly unique needs and challenges.
Exactly right. This quarter, they introduced the Microsoft Sovereign Cloud, a very significant offering.
Sovereign cloud, okay. What's the focus there?
It's designed specifically for customers with unique and often stringent data residency and sovereignty requirements. Think governments, highly regulated industries. This solution offers unparalleled flexibility, spanning both public and private cloud deployments. It's absolutely critical for organizations globally who need to ensure their sensitive data and AI workloads comply with national laws. It's a key differentiator in a world increasingly focused on digital sovereignty.
That seems like a smart strategic move.
It really does. And looking even further to the future, quantum computing is identified as Microsoft's next big accelerator.
Quantum. Are we talking real applications yet?
Well, this isn't just speculative anymore. Microsoft announced the world's first operational deployment of a Level 2 quantum computer in partnership with Atom Computing.
Level 2 operational quantum computer.
This public unveiling showcases their decade-long investment arcs. It demonstrates a profound long-term commitment to truly transformative technologies, not just immediate gains from current AI trends. They are planting seeds for the next technological revolution.
Okay, so this relentless innovation, both foundational and specialized, it's clearly driving tangible results, including accelerating growth from what they term durable migrations. Can you give us a concrete example of this in action and explain what durable truly means for the sustainability of this ongoing trend?
Nestle provides a phenomenal case study. This global giant migrated over 200 SAP instances, more than 10,000 servers, and a staggering 1.2 petabytes of data to Azure.
That's a massive undertaking.
Huge. And the astonishing part, they achieved this with near zero business disruption. This isn't just an impressive technical feat, it truly makes it one of the largest and most successful enterprise migrations in business history. And what this exemplifies, and what Satya Nadella emphasized, is that they are still very much in the middle innings of this massive enterprise migration trend.
Middle innings. So still a long way to go.
A long, durable runway for continued growth as countless other enterprises gradually move their complex on-premise infrastructure to the cloud. It's a multi-year, multi-trillion-dollar opportunity that continues to unfold.
But despite building all this capacity, they're still constrained.
Yes, and despite bringing substantial new data center capacity online at a breakneck pace, the demand for Azure and their AI services continues to outstrip supply. Amy Hood, their CFO, explicitly stated that they expect to remain capacity constrained through the first half of fiscal year 2026.
Through the first half of FY26.
Wow. This is a crucial point for investors. It means their strategic CapEx, that $24.2 billion we discussed earlier, isn't speculative spending. It's directly correlated to fulfilling that massive $368 billion contracted backlog. The challenge for Microsoft right now isn't generating demand. It's physically building fast enough to fulfill that demand.
So even with those colossal investments, they literally can't build fast enough to keep up with customer appetite. Amy Hood's point about not getting overly focused on a pivot point for CapEx versus revenue, but rather on gaining market share, that really stands out, doesn't it?
It absolutely does. It signals a strategic long-term play. They're prioritizing capturing the AI market now, even if it means sacrificing some short-term CapEx optimization. They're building the highway before everyone else, betting on the long-term traffic.
Right. Okay, so having laid that bedrock of AI infrastructure, the critical question becomes, how is this intelligence actually showing up in the hands of users? How is it fundamentally transforming how we work and interact? And this transformation, as with almost any intelligence system, it begins and ends with data, right? The lifeblood of AI.
Data is, without question, the foundational layer for every successful AI application. And Microsoft Fabric is rapidly becoming the complete, unified data and analytics platform for the AI era.
Microsoft Fabric. Okay, what does that encompass?
It's an ambitious offering. It encompasses everything from traditional SQL to NoSQL databases, and all the complex analytics workloads required to power AI. It's designed to be that single, unified solution, dramatically simplifying complex data management for AI development and deployment.
And how's the adoption looking?
It's gaining truly significant momentum. Revenue up an astonishing 55% year over year, over 25,000 customers already on board.
55% growth.
Yeah. This makes it remarkably the fastest growing database product in Microsoft's storied history. It unequivocally indicates rapid adoption and the immense perceived value it brings to organizations grappling with AI data challenges.
What makes it particularly suited for AI?
Its One Lake feature is particularly powerful. It creates a single, logical data lake that spans all databases and clouds, including semantic models from Power BI. This makes it an optimal unified source of knowledge for grounding AI applications and for context engineering.
Grounding AI applications, meaning
Meaning it provides the rich, reliable, and continuously updated data necessary for intelligent agents to function effectively, to prevent hallucinations and deliver accurate, relevant outputs. Good AI needs good, well-organized data. Fabric aims to provide that foundation.
makes sense.
And here's a powerful testament to the robustness and scalability of Microsoft's data infrastructure. Even OpenAI leverages Microsoft's data capabilities extensively.
OpenAI runs on Microsoft data tools.
Yes. They use Cosmos DB in the hot path of every single ChatGPT interaction for chat history and user profiles, and Azure PostgreSQL for critical metadata. This kind of reliance from a leader like OpenAI speaks volumes about the trust and performance Microsoft's data services deliver at an incredible scale.
That's a strong foundation in data. But
Yeah.
for our listeners, how are customers actually taking this raw data and foundational infrastructure to build and manage these intelligent AI applications and agents at scale? Beyond just the raw data, that's where the rubber truly meets the road, right?
Yeah.
Transforming data into actionable intelligence.
That's precisely why Microsoft launched Azure AI Foundry. It's designed to be the comprehensive platform for developing and deploying AI agents responsibly.
AI Foundry, huh?
It provides best-in-class tooling, robust management capabilities, deep observability, and crucially, built-in controls for trustworthy AI. For enterprises, these trust and control features are non-negotiable for deploying AI broadly.
What makes Foundry stand out?
Well, it uniquely allows customers an incredible degree of flexibility. They can provision inferencing throughput once and then apply it across a wider array of models than any other hyperscaler.
So you buy the power, then choose the model.
Kind of like that, yeah. This includes leading models from OpenAI, of course, but also those from DeepSeek, Meta, xAI's Grok, and soon, Black Forest Labs and Mistral AI. Microsoft even sim-shipped 15 OpenAI models this year.
Sim-shipped, meaning same-day availability.
Exactly. Same-day access to cutting-edge AI breakthroughs as soon as they were released. This unparalleled flexibility and breadth of model support is a significant competitive advantage. It allows customers to choose the best model for their specific task without vendor lock-in.
And are customers building agents with this?
Oh, yes. The new Foundry Agent service is witnessing truly accelerated adoption. 14,000 customers are already using it to build agents that automate increasingly complex tasks.
Could you give an example?
A compelling real-world example is NASDAQ. They're using Foundry agents to help prepare for board meetings, impressively cutting prep time by up to 25%.
25% less time on board prep? That's significant value.
It really is. These are tangible, quantifiable productivity improvements driven by agentic AI directly impacting high-value business processes.
And how widespread is Foundry adoption overall?
The diffusion is broad. A remarkable 80% of Fortune 500 companies are already utilizing it.
80% of the Fortune 500.
Already. And a key indicator of true platform diffusion isn't just the number of customers, it's the sheer volume of activity. The number of tokens served by Foundry APIs processed over 500 trillion this year.
500 trillion tokens.
Up over 7x. This is a clear signal that AI isn't confined to a few experimental head apps anymore. It's deeply embedding itself across the core operations of massive enterprises, becoming an indispensable part of their digital DNA.
Okay, beyond the underlying infrastructure and specialized agent development, the Copilot family of applications is showing truly incredible traction, bringing the power of AI directly into everyday workflows for millions.
The adoption figures are staggering. Copilot apps alone have surpassed 100 million monthly active users across both commercial and consumer segments.
100 million MAU for Copilot apps.
And even more broadly, AI features embedded across all Microsoft products now engage over 800 million monthly active users.
800 million, that's massive reach.
It underscores the immediate utility, the intuitive appeal, and the profound productivity gains that AI-powered tools are delivering to a massive global audience.
How's the core Microsoft 365 Copilot doing in enterprises?
Microsoft 365 Copilot, in particular, is rapidly becoming a completely new way to organize work and workflow within enterprises. It's adopting faster than any other new Microsoft 365 suite in history.
Faster than Teams adoption, for instance.
Faster, showing remarkable week-over-week retention. This past quarter saw the largest number of seat adds since its launch, with a record number of customers returning to purchase more seats.
So they try it, like it, and buy more.
Exactly. It indicates not just initial curiosity, but deep satisfaction, perceived value, and an increasing reliance on Copilot as an essential part of their daily work.
Are we seeing large deployments yet?
We are seeing major enterprise deployments, not just small pilots. UBS, for instance, is expanding Copilot to all its employees after a successful initial rollout to 55,000.
55,000 users at UBS?
And absolutely, customers aren't just consuming Copilot, they're actively extending it. They're using Copilot Studio to create their own custom agents. 3 million agents built this year alone.
3 million custom agents built by customers.
And with Copilot tuning, they can fine-tune these agents on their own company data, specific workflows, and even their unique brand tone and expertise. This level of customization allows organizations to truly tailor the AI to their specific needs, making it feel less like a generic tool and more like an integrated, intelligent team member.
That's a profound level of adoption and integration. It's clear that Copilot isn't just a general-purpose AI tool. It's making a specific, measurable impact in various professional roles, truly transforming how people work in specialized fields. Can you give us a glimpse into some of those real-world impacts?
Absolutely. Take GitHub Copilot, for instance. It now boasts an incredible 20 million users.
20 million developers using GitHub Copilot.
Yeah. The new agent mode and form factors, like the coding agent, which can asynchronously execute developer tasks, are game changers. Enterprise customers specifically increased by 75% quarter over quarter as companies increasingly tailor Copilot to their own internal code bases. Recognizing its value in large-scale software development environments, it's become so pervasive that a remarkable 90% of the Fortune 100 now use GitHub Copilot.
90% of the Fortune 100, wow.
It's cementing its role as an industry standard for developers. The impact on productivity is undeniable. AI projects on GitHub more than doubled over the last year, leading to explosive growth in overall GitHub usage and repositories. To give you a concrete example of its impact, the code review agent alone performs millions of code reviews each month.
Millions of automated code reviews monthly.
Significantly accelerating development cycles, improving code quality, and freeing up human developers for more complex creative tasks.
What about other industries?
Like healthcare. In healthcare, Dragon Copilot had nothing short of a breakout year. Customers used it to document over 13 million physician-patient encounters this quarter.
13 million encounters documented by AI.
Up nearly 7x year over year. This is a profound game changer for reducing administrative burden. Mercy Health System, for example, reported saving over 100,000 hours of physician time.
100,000 hours saved. That's incredible.
That's time doctors can now spend directly on patient care, or even reclaiming aspects of their personal lives previously consumed by paperwork. One physician famously called it the best thing to happen to my practice in 10 years.
That kind of testimonial speaks volumes, doesn't it?
It really does. About the human impact of this technology. And in the critical domain of security, Microsoft was the first to introduce agents designed to help defenders autonomously handle high-volume threats, a capability that is absolutely critical in today's increasingly complex and automated threat landscape. They are proactively extending existing security systems like Entra for identity, Defender for AI apps, and Purview for data protection to secure every single AI agent and application being built. All told, they now serve nearly 1.5 million security customers and continue to gain market share across all major categories they serve, highlighting their leadership in AI-powered security, which is, non-negotiable for enterprise adoption.
Beyond the enterprise, AI is also fundamentally reshaping consumer experiences and underlying platforms, extending its reach directly into how we live and interact with technology every day.
That's right. Microsoft introduced Copilot mode in their Edge browser, signaling their intent to build the next generation of browser for the AI age.
Copilot in the browser, how does that work?
This mode integrates Copilot's Composer, Chat, Discover, Search, and Actions into a unified web experience. It aims to redefine how users interact with the internet by making it more intelligent and assistive. The dedicated Copilot consumer app also saw very strong growth in engagement and successful sessions, indicating its appeal beyond just business users.
And Copilot is coming to Windows itself.
Yes, significantly. Copilot is coming to every Windows 11 PC. With Copilot Vision, users will be able to share their screen with Copilot and receive real-time insights and assistance on literally anything displayed on their desktop.
Share your screen with AI for hack. Interesting.
This positions Windows 11 and the new Copilot Plus PCs very strongly as Windows 10 approaches its end of support in October. It offers compelling security and AI value for consumers, giving them a powerful reason to upgrade and embrace an AI-first computing experience.
Okay, let's talk monetization. How do software companies, especially SaaS providers like Microsoft, actually make money from all this AI? Satya Nadella had an interesting take on this, didn't he?
He did. He offered a fascinating and, frankly, profound perspective. He drew a parallel to the historic server-to-cloud transition. He explained that AI is effectively an expansion of compute usage. He stated very succinctly that intelligence is basically log of compute.
Intelligence is log of compute. What does that mean exactly?
What he means by this is that while the effort or cost in terms of raw compute power goes up exponentially to achieve linear increases in intelligence, Microsoft is uniquely, perhaps supremely, positioned to monetize that exponential compute demand. By building the most efficient AI infrastructure and embedding intelligence deeply into widely used SaaS applications like Microsoft 365, they ensure that every incremental piece of intelligence generated by their customers translates into increased consumption of their underlying cloud services.
So it's not about selling AI features directly, but selling the compute used by the AI.
It's more nuanced, but that's a big part of it. It's not about selling intelligence directly as a static product, but about owning the infrastructure where that intelligence is born, consumed, and continuously refined. So SaaS applications are now embedding agentic and chat interfaces with intelligence, as well as building truly autonomous agents that can perform complex tasks. This isn't just a new feature. It fundamentally increases the usage of the underlying services, the compute, storage, networking, which translates directly into monetization.
So more useful AI means more cloud consumption.
Exactly. The more value these intelligent agents provide, the more they are used, and the more deeply they become integrated into workflows, directly driving increased revenue for Microsoft.
And how do they think about pricing models?
Amy Hood further elaborated that monetization models will continue to blend, moving beyond just simple per-user logic to include tiered per-user models and increasingly pure consumption models. This inherent flexibility allows Microsoft to optimize both value for the customer, maybe by throttling usage, or applying the most cost-effective models for specific tasks, and simultaneously optimize revenue for themselves by capturing the true economic value of the intelligence being generated. It's a dynamic and intelligent approach to pricing.
Okay, let's shift slightly. While the sources for this quarter don't detail specific expansion into a particular country like China, the global reach of Microsoft Cloud is absolutely undeniable. And it remains central to their overarching strategy, right? It's not just a nice to have, it's a foundational element of their growth story, particularly in an AI-driven world.
Absolutely. Reconnecting to our earlier discussion on AI infrastructure, Microsoft's commitment to global expansion is abundantly evident in their vast data center network. We're talking over 400 data centers, 70 regions, 6 continents. This expansive geographic presence isn't merely about serving customers, it's absolutely critical for the widespread adoption of AI. It ensures low latency for AI applications like Copilot, no matter where users are located globally. It also allows them to meet diverse and increasingly stringent regulatory requirements, particularly concerning data residency and sovereignty for AI models and the sensitive data they process. This global scale is a key differentiator in attracting and serving multinational enterprises for their AI strategies.
And the Sovereign Cloud offering plays into that directly.
Exactly. The introduction of the Microsoft Sovereign Cloud, as we touched on earlier, is a direct, calculated response to this growing global need for data residency and sovereignty. It provides a crucial capability for customers worldwide, allowing them to meet unique compliance demands in both public and private cloud environments. This is particularly vital for governments and highly regulated industries that need to process AI workloads involving sensitive national data while adhering to local laws. It's a strategic move that opens up significant markets for Microsoft's AI offerings.
And we see global companies adopting their services.
We do. We saw powerful examples of global customer adoption, like Nestle's massive migration. This case study isn't just about technical migration. It demonstrates how incredibly large enterprises across different countries and continents are increasingly embracing Azure and Microsoft Cloud services for their most critical core operations, including nascent AI initiatives. It highlights a clear global trend of digital transformation powered by Microsoft's cloud.
And AI adoption is global too.
Yes. As Satya Nadella mentioned, the broad diffusion of AI applications extends globally. This means the platform's reach isn't just concentrated on a few head apps in major Western markets. Rather, it signifies the rapid, pervasive adoption of new AI capabilities by a wide array of businesses and developers across the world. This truly universal impact underscores that Microsoft's AI strategy is not geographically limited. It's designed for and resonating with a global audience.
Okay, moving on to the Q&A session with analysts. This is where we really get to probe deeper into Microsoft's strategy, potential challenges, and how they think about the nuances of their business. It's often where the real insights emerge beyond the prepared remarks, isn't it?
Indeed. And Keith Weiss from Morgan Stanley raised a particularly insightful question. He touched on the dual nature of AI labs and startups.
Right, the idea that there are big customers but also potential competitors.
Exactly. On one hand, they are rapidly growing high-consumption customers for Azure. On the other, they are increasingly well-funded and soaring in valuation, posing as potential future competitors. How does Microsoft, he asked, navigate this inherent risk versus reward dynamic?
That's a great question. What was Nadella's response?
Satya Nadella's response really illuminated Microsoft's strategic thinking. He framed these large AI workloads, or head apps as he called them, as absolutely crucial for shaping the platform itself. He emphasized that having the largest AI workloads run on Azure, explicitly citing OpenAI's ChatGPT, provides invaluable learning opportunities. This isn't just about revenue. It allows Microsoft to optimize its entire platform from the silicon to the software stack faster than anyone else. It's a continuous feedback loop.
So they learned from the biggest users how to make the platform better for everyone.
Precisely. He expressed strong confidence that as long as these head apps continue to actively shape the Azure platform, driving innovation and scale, and as broad diffusion of AI capabilities follows across the enterprise, Microsoft will remain in an incredibly strong competitive position. It's a strategy of coevolution and learning from the bleeding edge.
That's a fascinating perspective, framing potential competitors as a source of platform innovation. What else came up? Carl Kerstead from UBS asked about the sustainability of that accelerating on-premise to Azure migration activity, noting it's been a material upside for Microsoft for 2 consecutive quarters. Is this a fleeting surge or something far more durable that investors can count on?
Right. Satya Nadella clearly identified 3 primary interconnected drivers of Azure's remarkable growth, all of which he sees as durable.
Okay, what are the 3?
First, the continued stream of robust, large-scale migrations from on-premise infrastructure to Azure, like that massive Nessie SAP migration we just discussed. He reiterated that they are still very much in the middle innings of this opportunity, meaning a vast amount of enterprise IT still needs to move to the cloud. Second, the scaling of cloud-native applications, even those not specifically AI-focused, where customers might come for AI capabilities but then expand to broader cloud services. And third, of course, the explosive growth of entirely new AI workloads. He emphasized that these 3 trends are not only strong individually, but are also building on each other, creating a powerful compounding effect that suggests significant durability for the overall growth trajectory of Azure.
Makes sense. Now, Kash Rangan from Goldman Sachs and Michael Turn from Wells Fargo both pressed on the persistently high capital expenditure and its potential impact on future margins, especially given the demand still significantly outpaces supply. It's a truly substantial investment, so these questions around its long-term financial implications are absolutely key for investors. How did management respond to that?
Amy Hood addressed this directly and firmly. She stated unequivocally that the CapEx is directly correlated to that massive $368 billion of contracted backlog that Microsoft is obligated to deliver across its cloud services.
So again, build it because they've already sold it.
Essentially, yes. Her focus, she made clear, is not on picking a specific pivot point where CapEx growth might slow relative to revenue. Instead, her primary objective is to meet existing demand, continue capturing surging market share in the cloud and AI space, and fulfill those long-term contracts. She views this spending as necessary to capture a generational market opportunity, effectively building the necessary infrastructure to process that guaranteed future revenue.
And Nadella added something about software optimization here too.
He did. Satya Nadella added a crucial layer to this, emphasizing that the true differentiator for a hyperscaler isn't just brute force hardware spending, it's unparalleled software optimization. He circled back to that GPT-4o example, where software alone delivered 90% more tokens for the same GPU. This, he argued, demonstrates how yield will come through innovation at the software layer, making those massive hardware investments incredibly efficient over time. It's Microsoft's software DNA that gives them a unique competitive edge in managing and optimizing their CapEx.
So the software makes the hardware investment go further.
That's the idea. And on the broader topic of margins, Amy Hood highlighted that the primary driver for sustained profitability is delivering great, competitive, and truly innovative products that naturally drive revenue and market share. She also noted that Microsoft applies its deep skill set to achieve efficiencies at every layer of the stack, from silicon to software, even amidst significant aggressive investment. This holistic approach to efficiency, coupled with market leadership, is what ultimately contributes to their impressive margin delivery, rather than just raw cost-cutting.
Okay, one more from the Q&A. Raimo Lencho from Barclays inquired if Copilot is simply a starting point, suggesting that data and increasingly autonomous agents might become even more central to the AI paradigm than the initial chat interface. Is Copilot merely the tip of the AI iceberg for Microsoft?
Satya Nadella firmly confirmed this perspective. He explained that while Copilot indeed begins with a familiar chat interface, its power rapidly extends far beyond simple request-respond interactions. It's about spawning essentially applications that then go do work and come back.
Applications that go do work. Like agents.
Exactly. He underscored that the user interface remains crucial, but its role shifts to instructing and monitoring this asynchronous work, allowing the AI to perform complex multi-step tasks in the background. A great example of this is the GitHub Copilot code review agent, which performs millions of code reviews each month, largely autonomously. This highlights a clear shift towards more powerful, autonomous agentic systems where the AI actively performs tasks and provides results, fundamentally changing how software and workflows will operate.
Fascinating. Okay, as we bring our deep dive to a close, what's Microsoft's guidance for fiscal year 2026? And what are the key risks they acknowledge as they navigate this dynamic AI-first landscape?
Microsoft's outlook for FY26 is remarkably confident. They expect to deliver another year of strong double-digit revenue and operating income growth, building directly on the impressive momentum of FY25.
Double-digit growth again.
Yes. And this is actually an improvement from some of their previous guidance regarding margins, reflecting increased confidence in their operational efficiency and strategic positioning.
And investments continue.
Oh, yes. They plan to continue significant investments in both capital expenditures, CapEx, and operating expenses, OpEx. This continued investment is unequivocally driven by their undisputed leadership position in commercial cloud, the persistent and strong demand signals for their AI and cloud offerings, and of course, that substantial contracted backlog of $368 billion. These investments are seen not as optional, but as necessary to fully capitalize on the immense generational AI opportunity.
How will CapEx look compared to FY25?
While CapEx growth is expected to moderate compared to the breakneck pace of FY25, there will be a greater mix of short-lived assets, primarily servers and GPUs, reflecting the immediate need for more compute power for AI. They anticipate higher CapEx growth rates specifically during the first half of FY26 due to the timing of capacity delivery, including some very large finance lease sites coming online.
But they still expect to be capacity constrained.
Crucially, yes. Despite these continued massive investments, Microsoft explicitly expects to remain capacity constrained through the first half of fiscal year 2026 due to the sustained strong demand signals.
Still can't build fast enough.
Pretty much. To put a number on it, Q1 2026 CapEx is projected to be over $30 billion.
$30 billion in Q1 alone. Wow.
It truly indicates the sheer scale of investments still required to meet this overwhelming demand for AI capacity.
What about margins for FY26 overall?
For company operating margins, they are expected to be relatively unchanged year over year in FY26. This reflects that delicate balance they're striking between making essential large-scale investments for growth and maintaining a disciplined focus on operational efficiency across their vast business. The FY26 effective tax rate is projected to be between 19% and 20%.
And cloud margins specifically.
Looking at specific segments, the Microsoft Cloud gross margin percentage is expected to be roughly 67% in Q1 2026, which is down year over year. Again, this is directly attributable to the ongoing substantial scaling of their AI infrastructure, a necessary strategic investment for future dominance and growth. For Q1 2026, Intelligent Cloud revenue is expected between $30.1 billion and $30.4 billion, with Azure projected to grow approximately 37% in constant currency.
Azure still growing 37%.
Yep. Productivity and business processes revenue is guided to be $32.2 billion to $32.5 billion, and more personal computing is expected to be $12.4 billion to $12.9 billion. These are all robust growth projections, signaling continued strength across their key segments.
Okay, finally, what are the potential headwinds or concerns that analysts brought up? And how is management directly addressing them to mitigate future risk?
Analysts certainly raised some astute concerns. One prominent one was that concentration risks stemming from large AI startups like OpenAI, paradoxically being both significant customers and potential long-term competitors.
Right, the risk versus reward question again.
Exactly. There's also the ongoing pervasive concern about the potential impact of these future large CapEx cycles on Microsoft's gross margins.
So how are they mitigating these risks?
Microsoft's management highlighted several key mitigation strategies. Foremost among them is their continued focus on software optimization, which, as we discussed with the GPT-4 example, is their unique way to extract maximum efficiency from their hardware investments. They also emphasized operational agility, allowing them to rapidly adapt to market shifts, and critically, maintaining a diversified product portfolio across cloud, AI, and productivity segments. This diversification reduces reliance on any single area or customer. Their overarching focus remains on investing relentlessly in security, ensuring unparalleled quality, and driving continuous AI platform and product innovation to deliver sustained value and opportunity to customers. This multi-pronged approach aims to ensure long-term resilience and sustained market leadership.
Thanks for tuning into The Deep Dive, where we decode the world's top companies, exploring what they do, how they grow, and why it truly matters. Today, we decoded Microsoft's Q4 2025 earnings, revealing a company that isn't just firing on all cylinders, but is accelerating into a new gear. Driven by unprecedented AI demand and truly strategic, forward-looking investments, we've explored how Microsoft is fundamentally building the future of AI from the ground up, not just participating in it. They're relentlessly scaling their infrastructure and embedding intelligence deeply into every product, from the cloud to the applications you use every day, and even into your PC. This isn't about incremental improvements. It feels like a fundamental re-architecture of digital work and computing itself.
Yeah, this deep dive unequivocally shows how Microsoft is not just responding to the monumental AI shift, they are actively defining it. With a confident outlook for sustained double-digit growth in FY26, even amidst the challenges of rapid expansion and managing immense, often overwhelming demand. Their strategic choices today are clearly setting the stage for tomorrow's technological landscape, impacting everything from enterprise operations to individual productivity.
If this deep dive gave you new perspective on Microsoft's strategic positioning in the AI era, don't forget to subscribe, share, and check out our other deep dives for more insights into the companies shaping the future.
And that wraps up this deep dive into Microsoft's Q4 2025 results. From 100M plus Copilot users to $75 billion in Azure revenue and a growing global AI backbone, Microsoft is more than just a software giant. It's becoming the foundational layer for the AI economy. Stay tuned for more earnings breakdowns and strategic insights right here on Know What You Are Investing, where we help you decode what companies do, how they grow, and why it matters. Until next time, keep investing with intention.